Right.
I think Deutsche Bank would bring down everything because every big bank in the world is a counterparty to Deutsche Bank's derivatives. And if they're not a direct counterparty, they're an indirect counterparty. So.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today we have an interview with one of my favorite analysts, one of the sharpest analysts, especially in gold and silver, and also in terms of shorting the markets, who's Dave Kranzler of Investment Research Dynamics. So Dave, pleasure to have you on again today and catch up. And how's everything going with you, my friend?
Well, it's always a pleasure to be on here. I love chatting with you. And, judging from feedback on Twitter, there's a lot of people out there who don't think I'm sharp and probably think I'm an idiot. So I just wanted to balance out that intro so that we have a fair and balanced presentation.
Well, that sounds like typical of the Wall Street crowd. I remember when I was there, I talk about gold and silver, and they looked at you like you were an alien, yet here it is years later, and perhaps as, gold and silver stagnate a little bit, but the reasons behind why folks like you and I think gold and silver are going higher continue to develop. We talked before we started about how Trump wants new Fed nominees to find new ways of weakening the dollar. And of course, at the same time, we have Deutsche Bank running into trouble again. So maybe to start, what's going on with Deutsche Bank and how close are we really to seeing some sort of trigger in these markets?
Everything's so opaque. It's hard to say, just how bad it is at Deutsche Bank. My guess is it's worse, way worse than is represented in the media. They still haven't. Originally, they defined the bad bank as being something like 46 billion in assets, or something, 43, I forget. It was under 50 billion. And now I think they came out and said it was going to be 74 billion or 78 billion. And who knows what that means? They haven't defined bad assets. Deutsche Bank's derivatives business, the legacy business to that is the Bankers Trust derivatives business. I was at Bankers Trust when they got nailed for screwing Procter and Gamble on derivatives. And BT was one of the pioneers of the derivatives market and the mass marketing of derivatives. And that's part of the reason why Deutsche Bank acquired Bankers Trust. And the guy that took over, a guy named Anshu Jain, the one time I met him before I pulled the ripcord from Deutsche Bank, I literally wanted to go home and take a shower after being in the same room with him. And, he's basically the Angelo Mozillo, if you remember him, the Countrywide, subprime mortgage guy who should have been thrown in jail. Instead, he left with a 9-figure retirement parachute from Countrywide. Anshu Jain is basically the mathematical derivatives version of Angelo Mozillo. He's about as corrupt as you can get. And I do remember, a lot of people probably don't remember this, but I do remember at one point before they finally got rid of Anshu Jain, he had admitted that he has no idea where all of their derivatives are buried. And if you've ever worked on a trading desk, you can understand that. We used to use derivatives to bury positions and hide them from the back office. So, if we were doing that in the 90s, I guarantee you, it is going on to a magnitude of 100 times over the last 20 years at Deutsche Bank. So, who knows how bad it really is. And I know like when we had the shale oil boom, I know Deutsche Bank was running around Canada doing like these very, very obscure over-the-counter type derivatives that were tied to energy. And, there's no telling where those ended up, what they look like, what they're valued. And that's just part of Deutsche Bank's problem. So my guess is it's being set up in a way that will enable the German government and the ECB to monetize it. And believe me, the Fed and the Bank of England will be kicking in on that, as well as the Bank of Japan. They'll all be asked to pony up to bail that out. Otherwise, I do think it would cause a systemic collapse if they just said, okay, let's let the market do what it may, which is what they should have done in '08.
Right.
I think Deutsche Bank would bring down everything, because every big bank in the world is a counterparty to Deutsche Bank's derivatives. And if they're not a direct counterparty, they're an indirect counterparty. So,
Yeah, it does seem like
there's just no way to speculate. All you can do is speculate exactly what's going on and how bad it really is. I'm just saying it's way worse than what it appears on the surface, or what it's being made to be on the surface.
yeah, I mean, certainly with good bank, bad bank, it reminds me a lot of subprime CDOs where you have bad loans, you're packaging them in a variety of different Enron-ish ways, yet in the end, the debt's there. Like you mentioned, the derivatives are there. One thing that I hear a lot about is that, especially with those derivatives, a lot of them do involve the precious metals market. So certainly we hear a lot about how much paper there is on the COMEX, but a lot of derivatives further in the precious metals market. And certainly I would think if Deutsche Bank did fail, could that potentially, something like that, be a spark to eventually get us to this point where the manipulation in the precious metals market is overwhelmed?
I don't I don't know if specifically a Deutsche Bank collapse. Well, what are we talking about? I mean, essentially what we've watched is a de facto collapse of Deutsche Bank. I mean, it's being held up by the central banks and the German government, and that's been admitted basically in so many words. So um, I, I don't really look. I don't consider Deutsche Bank to be one of the integral players in manipulating the precious metals market. I mean, they were at a point, but they got their wrist slapped. They were used as a scapegoat, and they kind of pulled out of it several years ago. So I do think that part of the rise in the price of gold that we've seen, the abrupt rise, is in part connected to the turmoil that we don't see on the surface going on behind the scenes that is connected to Deutsche Bank. You know, I don't think there's any coincidence that gold runs from essentially 1285 to as high as 1445 in a very short period of time, around the same time that all this news on Deutsche Bank started coming out. So
Although, how much of that is tied to this recent gold rally is tied more to the positioning? Especially, I bring that up because you had an article last week where you saw that a lot of these banks were short in the gold market, and I believe you put on a trade that did pretty well when gold got pummeled on Friday, almost like clockwork. So is it more just what these funds are doing, and to what degree can you actually game that?
Well, I've been trying to game it on the short side this week and not doing nearly as well. So I'm actually kind of surprised at how resilient gold's hanging in right now in the face of data and evidence that would correlate with periods of time when the price is attacked aggressively. You know, especially around events like the Jerome Powell testimony to Congress today and tomorrow. So yes, for sure, part of the run up in the price of gold is the hedge funds aggressively chasing the price higher. It's just like they chase the price of everything higher. I mean, who's running the price of Beyond Meat up as high as it is?
Right.
You know, stocks like that. I mean, part of it is the hedge funds. I mean, Netflix has horrible news announcement yesterday, and the stock's up. I don't know where it is right now. It is up, you know, over $4 at one point today. I mean, that's
some of these tech stocks don't go down.
Momentum. So, you know, the hedge funds, you know, if there's momentum to be chased, they don't care what it is.
Right.
You know, if it was dead skunks that were rising in price, or a derivative of dead skunks rising in price. The hedge funds would chase the price higher. So part of the gold and silver run up, more predominantly in gold, it was for sure hedge funds, loading up the long side of their book with COMEX contracts, and the data that we've seen so far, even though it's opaque to some extent and lagged, verifies that. So, and the banks are in a position now where they have an extremely large net short position. I haven't crunched the numbers on that are in my database that I keep of, the historical numbers going back to like 2006, but we're at a pretty high net short position for the banks. Historically, they've managed to convert that into profits by attacking the price and pushing it lower. I thought we were going to see that early this week, and I mean, so far the metals and the mining stocks are hanging in really well. And if they continue to hang in and move like this, it could be a sign that the banks have lost control of their ability to, at least for now. And we've seen that a couple times over the last 18 years that I've been doing this, where the banks have a large net short position. October 2008 is a good example, where they just have somehow, there's other forces in the market that are overwhelming their ability to cap the price or take it lower with derivatives.
Yeah, it's certainly interesting when you watch what the banks are doing. It was maybe about 2 months ago, I had an extra silver position because, again, it's not a perfect science, but you'd seen that the banks had, bought pretty much as much silver as you think they could get from these funds. And interesting how you can pick spots. And I think, what's nice is if you don't expect to win on 10 out of 10, but if you pick some educated spots, which again you do help folks look for in your mining stock journal and short sellers journal. And I wish your email about last week hadn't gotten stuck in my promotions folder, so maybe I would have put a short-term short on the gold market, but such is how it goes. Although for investors that maybe aren't looking to trade as actively, but for the folks who see, all right, gold and silver, we get it, they're writing a lot of paper, it's manipulated, don't know when, but at some point the price is going to go up. So if they're expecting higher bullion prices and interested in mining stocks, what's really the stage of a miner or explorer where, to me, I always thought, if I'm really just trying to amplify my bet on the price of metal, I probably want the guy that already has it, or they know they have it, as opposed to someone who's exploring, where you have a different set of risks where they may or may not find it. So for folks who really just see higher bullion prices, what kind of miners would they be well served to look at?
It's kind of like everything else. I think you want a diversified portfolio of some large caps, some mid caps, and some juniors. And there's obviously different gradations of juniors, and it just depends on what your risk tolerance preferences are. Again, it's like everything else. I wouldn't buy stocks like Newmont and Barrick. I think they're gonna, assuming that this trend that we're in right now continues higher. And believe it or not, if you look at charts, gold's actually been rising since mid-August. So it wasn't just like, the move from 1285 to where we are now came out of nowhere. It's been in a steady uptrend since mid-August. The mining stocks, if you just use GDX as a proxy, those have been in a steady uptrend since mid-September, and silver's been in a steady uptrend since mid-October. And those are all kind of classic characteristics of what we want to see in the early stages of a bull market. So at some point, I expect silver to overtake it all and outperform mining stocks and gold. And when that'll happen, I don't know. And specifically, silver stocks will probably outperform all the other mining stocks. So if I was building a portfolio, that was going to be a buy and hold portfolio, I'd put some large cap stocks in there. I like Agnico Eagle. I think it's a really well run company, and that would probably most of the large caps I don't really care for. Many of them like Newmont and Barrick are depleting their reserves faster than they're replacing them, and that's a problem. But the juniors will benefit from that. The juniors that can find actual deposits that are mineable, they're going to be acquired by the Barricks and the Newmonts and Agnicos of the world. So, and then there's some mid-cap mining stocks that I like. And again, a blend. You want to buy a blend of gold and silver producers. The easy way to do it is just buy SSR Mining. It was historically a silver mining company, and now they're diversifying into gold, and it's been a great performer over the last year relative to the sector.
Right.
So, and then the juniors, I don't want to give away the stocks that I put in my mining stock journal. I like to try and keep those as much as possible proprietary to subscribers, but there's some junior stocks that are just now starting to explore and develop property, and those are potential 10 baggers. Of course, they're potential zeros also. Right. You probably want a couple of those, and then there's juniors that are in various stages of development and defining deposits, or juniors that actually have defined deposits, and you probably want a handful of those in your portfolio also.
Would it be fair as a general rule to say that in the juniors you have perhaps a higher ceiling or upside, yet on average a lower chance of hitting that than perhaps a more advanced stage company?
Oh yeah, if you look at a risk return curve, certainly the juniors are extremely high risk, high return. Now I will say that the expected value, if you buy a portfolio of junior miners right now, the expected value risk adjusted is higher than it would have been in 2011 after that big run up. I mean, a lot of these juniors are selling, kind of below what I would define as their intrinsic asset value.
They've gotten beaten up pretty good.
Yeah, I mean, I'm looking at I was just doing part of the write-up for my next mining stock journal, and I'm looking at a junior mining company, and I mean, this company already has a deposit. I mean, if they wanted to stop all their exploration and just mine the 1 million ounce deposit, the stock probably would be capped in the market at somewhere between 70 million and 100 million. And the market cap of the stock's $15 million. I mean, it's ridiculous. So, and I don't want them to do that. I want them to keep drilling their property, because they could be sitting on a massive gold mineralization system. It looks like they are by the, indications of all the drilling they've done so far. So, and the market doesn't care about it. They release really strong drill results and the market yawns. So, but to me, that's a value play at this point, as opposed to just, I like to call the junior explorers venture capital companies, because that's basically what they are. Raise some capital and try to find a gold deposit in an area where you think there's a likelihood that there might be a gold or silver deposit. But now, like for instance, this company I was just talking about, I mean, I look at that also as a value play, not just a venture capital play. So
yep.
That's how undervalued the juniors are as a sector relative to the rest of the sector and relative to the stock market.
Yeah, I've been stunned over the past decade that certainly when you look at what's happening in the world, how undervalued some of these seem to me. And perhaps our final question, have you ever come across any asset investment profile that stacks up better than silver at this present moment?
It's always silver with you. What is it?
Well, I mean, that's part of it, where I can't think of anything I've studied, traded, or read about historically that is as mispriced as silver right now. And I'm curious if anything comes to mind that, is that fair in your opinion to really phrase it that it really is perhaps that extreme, the mispricing?
Yeah, hey, Elon Musk's robo-taxi fleet that he's promising, right? Isn't he saying he's going to have 1 million robo-taxis? And And once automatic pilot is perfected, he's going to stop producing cars and just have I don't think the market's giving enough value there to that. Maybe that's cheaper than silver right now. All kidding aside, look, I'm with you on silver. I've always felt that silver has been undervalued relative to gold, relative obviously to the stock market and the bond market. I mean, the gold silver ratio right now is 92-1. It's absurd. Silver gets pulled out of the ground at a ratio of about 9-1, 9 ounces of silver for every ounce of gold. Over very extraordinary long periods of time, the average gold silver ratio has been 16. It's varied around that. Will we ever see that again? I don't know. I always thought we would. And I think we could even see a lower gold silver ratio. It's 70% of the silver that is produced is used for industrial applications, so it depletes. Now, some of that gets recycled, so it's not 100% depletion, but 70% is the world needs it, to make your life better. Right. And 70% of the silver that's produced is a byproduct of base metals mining. When you have a bad economy, base metals mining contracts. So that's going to affect the mine supply of silver. I agree with you. I mean, I think both gold and silver, and more so silver than gold, are not just wealth preservation assets right now. I also think they're undervalued as investments. So I think if you buy gold and silver right now, you can expect that over the next 2 to 3 years, maybe more, you're going to have a rate of return that I think gold and silver outperform the stock market over the next couple of years. I mean, if you look at it since 2001, gold has outperformed the stock market from 2001 to now. And then it's went through a period of underperformance, after 2011. And I think gold will outperform the stock market going forward from here for the foreseeable future, again, defined as anywhere from 2 to 5 years. And to the extent that gold does that, silver will do it even more. So, because at some point that gold silver ratio is going to start coming down. It bottomed out, I think in 2011, it was, low 30s, something like that. And I actually think, and we can figure it out, what's 825 divided by 50, right? That would have been your gold silver ratio in 1980, 1981. So, to me, silver right now is the ideal investment. And I would start with buying silver bullion coins, silver eagles, silver maple leafs, whatever your favorite flavor is of that. And then if you want to put some in your trading account, I'd probably use either the Sprott ETF or just use SLV. Although I still am an advocate for, if you're going to invest in gold and silver, buy the physical and keep it yourself.
Yeah, and quick plug for one of our sponsors, Miles Franklin, which can give you the ability to buy or sell any precious metals you need at 833-326-GOLD. That's where we've gotten some of those silver coins I've sent over to you over the past year or two, Dave. So
I know, I appreciate those.
I think you're right on board. I also appreciate that you mentioned how, yes, gold and silver do serve as an insurance policy. Yet at the same time, the insurance policy could be incredibly mispriced, which I think we both agree that it is. And I guess perhaps in closing, just if you can let folks know where they can find you. Again, I'll happily refer and recommend both of your journals because you have some great ideas in there.
Appreciate that.
And also you cover what's going on in the market and give specific ideas people can look into. So where can they find that, my friend?
Sure. My website is investmentresearchdynamics.com, and it's a free blog. And then I have links at the top where you can find out more about the Mining Stock Journal and the Short Sellers Journal.
Well, I'll be looking forward to the next Short Sellers Journal on Sunday, Mining Stock after that. Again, Dave, always great catching up with you. Thanks for the insight, and we will do it again soon, my friend.
No, the pleasure's all on this side of the video camera. Thanks for having me on. Look forward to doing it again.